Allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Hi, this is Manoj Abhichandani, and we would be talking about limited recourse borrowing arrangements. And I'm just going to wait for a couple of moments for other people to join in, and then we'll commence in a few moments. Thank you. Right. We're going to talk about a limited recourse borrowing today, and this topic is particularly important for superfund auditors because they would be, for the first time, looking at funds which have borrowed and they have fixed the safe harbor rules. They've fixed, the trustees would have fixed their safe harbor arrangements or limited recourse borrowing arrangement from related party, which they had to do by the 31st of January 2017. So just to mention here that borrowing by a self-managed super fund is a financial product. So whatever I'm talking about is of generic nature. So just a disclaimer here to let you know that anything specific to yourself or to your client, you need to get specific advice from a financial planner instead of from me. Now, the topics today would be, we'll be talking about Section 67A and Section 67B of the SIS Act, and that's where the borrowing rules are. And I'm going to talk about step by step the whole process on how the borrowing actually work and what are the documents which you will require when you're putting borrowing into a self-managed super fund. You would need a new investment strategy which allows the super fund to borrow the money. Now, you will need a security trust deed, which we, for our today's conversation, we'll call it a property custodian trust deed. You will need some resolutions, that is, the members should agree that they want to borrow money. And then we'll be talking about setting up the custodian trustee company, that is the trustee of the property custodian trust, and who should be that entity. We'll also talk about stamp duty, capital gain tax issues, and what are the points you should be watching out for if you're auditing a fund which has borrowed money. Now, before I step into the main webinar, I just want to talk to you about if just some housekeeping rules. Now, in your dashboard, you will see that there is, in your panel, you will see that there is a phone number provided. So if you can't hear me, you will have to ring that number and then put in a PIN, and only then you'll be able to hear me if you can't hear me through your computer. The other thing which I want to talk about is questions. There is in your panel a section for questions. So what I will do is I will finish my presentation, and if you put your questions there, we will go through all those questions after my presentations. Now, if you want a copy of these slides, I will upload them at the end of the presentation in your panel, and you will be able to download from the handout section This I will do after the presentation is over. So you'll have to hang up. You'll have to stay online and wait for me to upload the documents so that you can download them at your end. Um, Now, we're going to talk about issues with borrowing. Basically, the SIS Act, Section 67(1), prohibits any borrowing. By Section 67(1), you cannot borrow. The APRA circular also talks about that you're not allowed to borrow, but some borrowing is allowed, like to pay a benefit, and that borrowing is only for 7 days. Surcharge is no longer applicable, and there is some limited type of borrowing allowed up to the 10% value of the fund if the fund is going to purchase some securities and within 7 days the trustees are aware that the monies would be available. So we're going to talk about basically the exceptions of the borrowing rules which are contained in section 67(1), and those exceptions are in 67A and 67B, the non-recourse loan arrangements. Now, these sections talk about a situation, talks about an exception and circumstances where a self-managed super fund can borrow. So the main criteria is that the borrowing should be for a new asset and it cannot be for an existing asset. So say the super fund owns a property and it wants to refinance that property because it was earlier on paid fully in cash. That is not possible. But once you borrow on that new asset, then refinancing is possible. Now, the second thing which is very important is that whatever the borrowing is for, it should be a single acquirable asset. To give you a definition, so let's say if you're borrowing to buy Westpac shares and Commonwealth Bank shares, you'll need two separate property custodian trustees for Westpac and Commonwealth Bank. And the same way, if you're buying a property and let's say the car park is on a separate title, you will need two separate property custodian trustees and you'll need two separate loan structures, and there will be two separate borrowing as far as the super fund is concerned. So the first criteria is the super fund should be allowed to purchase that asset. There are certain assets super funds are not allowed to purchase. Section 66 talks about acquiring a residential or property from a super fund, which is not allowed. So all those criterias should be fulfilled before a self-managed super fund can borrow. And once they borrow, that asset must be held in trust. So what the super fund does, it acquires a beneficial interest in that trust. So the owner of that asset cannot be the super fund. The owner of that asset should be a separate entity, should be a separate trust. And the super fund should have the right to acquire the ownership of that asset by making a payment to the lender. So once all the payments are made, that right must always be there. That is, the trustee of the super fund should be able to acquire that asset from that trust at any time. Now, in case of defaults, that is, if regular payments, monthly payments, or you may call it end of the year payments, if they are not made to the lender, whatever the terms are of the lender, then the recourse which the lender has is only against the property and not against the other assets of the super fund. Now, today's discussion is going to be mainly on related parties lending to the super fund, but we will touch on few aspects where the super fund buys from an external party, and I'll also define what is a related party and what is not a related party of the super fund. Now, let's start. If you're an advisor, the first time you'll get a phone call from your client is that to say that there is a property in place. There's a property or an asset, or let's for our discussion, we're going to ignore the shares side of things because usually super funds can buy a CFD, contract for differences. So we're going to talk about mostly property. So the first time you'll hear about one of your clients or you yourself want to borrow is because the trustees wants to purchase a property. So when the property is purchased, sometimes you will find that the client does not even have a super fund. So the first thing you'll be doing is setting up a super fund with a trustee of the super fund. And the next thing is you must set up, when the super fund is borrowing, the trustee of the property custodian trust. Now, banks do not like individual trustees, and they do not like individual trustees of a property custodian trust. Whereas when there is a related party lending to the super fund, then we can have either one of these trustees as individuals. Um, you cannot have individuals on both the sides, because then it will create a merger, because it will be the same people holding the property for trust for the same people. So if let's take an example. Let's say there is husband and wife who are the trustees of the super fund, and you decide that instead of having a corporate entity which will be the trustee of the property custodian trust, you decide it will be the same two people who would be the trustees of the property custodian trust. So what we are trying to do is we are trying to avoid a situation where the same person is holding the asset in trust for the same persons. So, if a related party is lending, I suggest that one of these two parties, that is the trustee of a self-managed super fund or the trustee of a property custodian trust, be a corporate entity, because the corporate entity is a separate legal entity. And of course, the same members, the same trustees can be directors of that corporate entity, but at least that corporate trustee would be the one which will be either the trustee of the super fund or would be either the trustee of the property custodian trust. Now, the next thing you will be doing is you'll be setting up the property custodian trust, and then the asset would be held by the property custodian trust or by the trustee of the property custodian trust for an absolute benefit for the super fund. And of course, the super fund is a trust, it is controlled by trustees. So we're talking about an absolute control by the trustee of the super fund. Now, the lender comes in and the lender will lend the money to the trustee of the self-managed super funds. And I've seen quite a few times auditing super funds, the loan is actually in the name of the trustee of the property custodian trust, and then it becomes a separate trust because the super fund is not at all involved in the whole transaction. So this is one of the things which auditors should be very careful about, that the loan documents are actually in the name of the trustee of the self-managed super fund. Now, the lender should put a mortgage in a related party, and I'm going to talk about the safe harbor rules, and we'll get to that very soon. But the lender will put a mortgage over the asset, and the trustee of the property custodian trust should allow that mortgage to be installed, because actually the trustee of the PCT is not holding the property it's in its own right. It's holding the property for the trustee of the super fund. Now, assuming the whole transaction goes smoothly, the rent would come in, and the rent doesn't have to be paid to the trustee of the property custodian trust. The rent can be paid into the super fund bank account, and once the money comes in, the loan agreement would have certain interest payments and principal payments to be paid to the lender. So they should function automatically on a monthly or quarterly or whatever the terms are on those basis. Now, these rents sometime come from a related party, in the sense that it's possible that if it's a business, a real property, that this property is actually leased to a related party. So this rent can be paid from the trading entity of your client to the client's self-managed super fund. And it's also possible that because of the rent and new contributions coming into the super fund, the loan is actually repaid by the super fund, and that will happen over time. So let's say 10 to 15 years time, the super fund has enough money and it's paid off the interest, then the lender technically just goes away. And then what will be left with a situation like this, that is the trustee of the property custodian trust is still the legal owner, and the property custodian trust is still intact, and the beneficiary of the property custodian trust is the trustee of the super fund, which is fine. And you can also transfer the property, which is also fine. So section 71(8), and there's a determination which I'm going to talk about, allows either one of the two trustees to hold the property after the loan is repaid. So if it's a related party which is lending to the super fund, if the loan is repaid, the trustee of the property custodian trust can actually continue holding the property should they desire to do that. And now, if you do transfer the property into the trustee into the super fund, and then the legal title is transferred from the property custodian trust, basically the trust is deemed to be nullified because it's not holding an asset, the single asset for the trustee of the super fund, and it's no longer required. You can simply close that company if you like. Now, because one day you will pay off the trustee of the property custodian trust and this company. So the question is that which one of them should be a company? Because one day you will be closing the property custodian trust because you will be repaying the loan. So it'll be quite logical to, if because one of them has to be a company, it'll be quite logical to have the trustee of the super fund to be a company for two reasons. Because then once the property is transferred to the super fund, the company can carry on as the trustee. And here, where the company is the trustee of the property custodian trust, you might have to close down the company. The second reason being the annual review fee, whereas the trustee of a super fund will pay a reduced fee of 47 odd dollars, and the trustee of the property custodian trust will pay about 280 odd dollars. So it's logical to have the trustee of the super fund to be a corporate, and the trustee of a property custodian trust can be individuals. Now, just to let you know, if you're borrowing from a bank, then they would like a company to be the trustee of the super fund and a company to be a trustee of the PCT. So you'll have no choice but to have two companies, and the companies have to be separate. It can't be the same company again because of the merger rules. Now, as you can see, there are lots of parties involved. There's a super fund, there's a trustee of the super fund, then there are members of the super fund, and then there's a trustee of the property custodian trust. There's a custodian trust, and then there's a vendor of the property who has to be paid out, and then there's a lender and the property itself and the loan arrangements. So we'll briefly talk about all of these parties. Now, the f- we must before we get into any of these arrangements, we must always look at this section 62, the sole purpose test. So we should be acquiring a property which is beneficial for the retirement benefits of the members, and in case of death, the ancillary objects of a self-managed super fund. So before the trustees embark on this whole project, that Section 62 issue must be addressed, and the way to address this issue is to have a set of minutes and a decision made that the purchase would be beneficial for the members. The second thing is that the trust deed must allow investments in limited recourse borrowing. Now, if you have an old deed, the rules came in sometime in September of 2007, and if your client has a deed which is older than that, then obviously self-managed super funds will not be allowed to borrow. So the option you have is to update the deed. Now, the second thing is investment strategies. Some of your investment strategies would say that super funds will not borrow, so you need to have a look at that, and you need to update the and update the investment strategy of the fund. Now, where we have a problem and where the safe harbor rules come in is Section 109, and that's with the arm's length dealing with associated parties. Like we can lend to a super fund, a related party members can lend to the super fund, but the terms of the lending should be at market value, and or whatever the fund can borrow at from another bank. So the lending should kind of like mimic a bank lending, and you should do all of those things to lend money to your super fund, which a bank would do in normal circumstances. Now, if the tenant is also a related party, then your rent, which you will be charging to the related party, to the trading entity. So let's say there is a factory which you are intending to buy, and the trustees are running that business through a discretionary trust. So if that discretionary trust is paying rent, that rent should be at market value. And we're talking about Section 109, and if you are the auditor of that fund, sometimes it could be very difficult to determine the market value of the rent of that property. So sometimes it'll be a good idea to get an outsider, a specialist, valuer to determine the rent which is being paid by the related party. Now, the trustee of the self-managed super fund should be a corporation, and we've discussed it in a related party situation as well. And it cannot be the trustee of the property custodian trust. So we're talking about two companies where the bank is lending, and the banks would say, you'll have that you should have the same directors as the trustee of the super fund. So that means Section 17A, where all directors must be members and all members must be directors. You're talking about a very close knit company where all the members of the fund are also directors of the property custodian trust, or the trustee of the property custodian trust. Now, I'm going to just mention to you of some of the risk involved, because if a related party lends to the super fund and if there is no tenant, then there could be a situation that is that the interest and the principal may not be payable, and this is where the safe harbor rules kick in. And then if you're not paying the interest to a related party, then and if you're not taking action to sell the property or acquire that property from the super fund, you're basically having an advantageous situation than a bank would, and you're not mimicking what a bank would do, because if you stop paying to the bank, then the next thing is that they will evoke the mortgage and try and auction the property to recover their money. So you should be doing all of those things. The second thing is pension funds. Now, if there's no rent coming in, then obviously there's no cash in the fund. And if there's no cash in the fund, then the minimum pensions are not being paid. And if there's not enough cash, then for pensions and interest, then obviously to keep the fund complying, you might be thinking that I'll get away with not paying the principal and the interest. So that could create a problem for you for those NALI provisions where it is non-arm's length income. And obviously, there's no income coming because there's no rent coming in. And I'll explain to you further in another picture. Now, the ultimate responsibility is lies with the trustees of the super fund. So before they embark into this whole project of borrowing from a related party, we should, as an advisor, inform them of all these problems of paying pensions and paying interest and principals. Now, as far as the members are concerned, they can, they can lend to the super fund, and all those lending should be on commercial terms. And I'm going to talk about non-arm's length income (NALI), I'm going to talk about safe harbor rules. And one thing you should note is that if the interest rate is below the market rate, that means that the members have actually contributed to the fund. And if you charge too much interest rate, that means that you're trying to withdraw an excess amount out of the super fund. And Section 65 talks about withdrawals by members, which are illegal. So you have to be very careful, and there is some guidance available, and we're going to talk about those guidance which are available from the tax office. We've talked about negative cash flow. So if there is no rental income, then obviously contributions would be required from the members. If they want to reduce the loan, or they must be thinking of getting into some sort of a salary sacrifice arrangements if it's not a business client, to make sure that principal and interest are paid. Now, interest may rise in future because the ATO guideline talks about a certain interest rate. It's quite possible in future interest rates may rise, and if they do rise, then it's possible that this higher interest rate, is not the rent which is being received by the super fund is not enough to pay any interest amount, and of course it will not be enough to pay the principal amount. So it's quite possible that there would be shortfalls, and if there are shortfalls, we have to see whether the client has the ability to put in new contributions. You have to check whether the client is working or not, and would the 9.5% be enough to pay the principal amount back as well. Now, the safe harbor rules are described in the Practical Compliance Guideline 2016/5. And what they say is that all income is nully if you do not follow the guidelines, and the ordinary income generated by that asset through that LRBA arrangement is not consistent. And because that dealing is non-arm's length, so whatever the rent is coming in, that income will become non-arm's length income, and that income will be taxed at 47%. Now, before we proceed, it should be very clear that this is just a guideline. It's not a legislation. So if the trustees do not meet the safe harbor terms, it does not mean the arrangement is non-arm's length. What it means is that there is no certainty provided. So, what I'm trying to say out here is that if one of the conditions, I'm going to talk about those conditions in the next slide. So, what I'm trying to say out here is that if your client does not meet any one of the safe harbor terms, it doesn't mean that it's non-arm's length income. So if you're the accountant, don't assume that in the accounts and calculate tax as if it'll be non-aligned, it'll be non-arm's length income. What it is just just um, how should I put it this way? It just signifies that there is no security, that there is no certainty that this income will be non-arm's length income. It may be non-arm's length income, it may not be non-arm's length income, but it does not mean that it is non-arm's length income. So what the tax office did when they provided these guidelines in 2016, they said to everyone to fix their arrangements till 30th of June 2016, and then they extended it because there was a bit of a backlash, and they extended that date to 31st of January 2017. So if there are any auditors looking at these type of loans, you should be looking whether you should be checking whether these arrangements were fixed by that date, by 31st of January. Now, the PCG 2016 and 5 basically talks about six different types of terms which should be in a related party loan to the super fund. The first is the interest rate. And again, we are talking about property only because the guideline also talks about shares and in companies and units in a unit trust. So we're just talking only about property here. So the first item is interest. So the interest should be for the 2016-17 year should be 5.65, and according to the RBI, they've given us a formula. So for the rate for 2017 and 18 should be 5.8%. So another thing which you can check is if you have clients who have lent money to their super fund, you have to check whether the interest rate has been changed since July 2017 or not. And if they haven't, you should be writing to those clients and saying that the interest rate now to be paid to the related party should be 5.8%. Now, a related party cannot give a loan for longer than 15 years. And the LVR, and this is where the maximum problem was, because what was happening before the PCG 2016/5 came in, related parties were lending 100% of the money to the super fund. So what the tax officer said that this is not what a normal bank would do. A normal bank would not lend more than 70% of the market value of that property. Now, that 70% LVR was used for residential and commercial properties. So it was one blanket, whereas we are aware that banks would lend to a self-managed super fund even up to 80%. So the related party should also install a mortgage. That means on the title deed. So if you're an auditor, you should be looking at those title deeds, looking at the lender, and seeing whether a mortgage has been installed or not. And if you see that there is no mortgage, please note that this is not a contravention. What it is that the trustees, what they have done is they have not complied. So I would be thinking that you will be writing a management letter to the trustee and telling them that this has not been done. And since you are responsible to inform the tax office as well, I suggest you should notify this breach in question number 18 in the contravention report, not in the actual breach. So it is a breach, but it is just informing that section 67 has been and B have been complied, but the mortgage has not been installed. So it's just an item, one of the items, and then it is up to the tax office to raise the issue with the tax office, with the trustees of the super fund and with the lender, that why that mortgage was not installed on that property. And it is not for the auditor to tell the accountant to to calculate tax at the rate of 47% because there's no mortgage installed on any of the rental income being received by the super fund. Basically, all you're doing is informing the tax office that this one aspect, the safe harbor, the has not been done by the trustees of the super fund. Now, mostly the breaches are in the monthly payments because many times the related party is a member of the super fund, or it's a company or a discretionary trust of the super fund. So the super fund is not able to pay monthly. And the second thing is it's not able to pay principal plus interest. It is either paying ad hoc amounts and it's not paying regularly on that certain day of the month. So this could be a serious breach because if the principal is not being paid, then obviously the super fund trustees are not complying to the taxation determination 2016 and stroke 16, and this could be a serious problem. And the problem could be is because there's not enough cash in the super fund. Because a 15-year loan could have a substantial amount of money as being repaid as principal of that loan amount. And it's quite possible that the rent is not enough to to make those monthly payments. So assuming the rent is about, because the rent has to be market rate, so assuming the rent is about 7 or 8% on a commercial property, um, the interest which has to be paid is 5.65% or now 5.8%. So let's say the the rent is 7.8% and the interest component is 5.8%. So you have only 2% excess available. And it's quite possible, because it's a 15-year loan, that the principal could be, say, 8 or 9%, or to which must be repaid to the lender. So it's possible that there's not enough money, and this could be a breach. And it's quite possible many funds who have borrowed from a related party are breaching the PCG 2016/5. So under those circumstances, it will be the auditor's responsibility to actually inform the tax office of the breach and let them know that these payments are not being paid on a regular basis. Now, I also urge you to have a look at TD 2016/16, because it talks about, uh, a loan, a hypothetical loan which the super fund could have borrowed, but it has not borrowed, but it could have borrowed, and the terms they would have got on those loans. Now, let's talk about the trustee of the property custodian trust. The trustee of the property custodian trust actually is the legal owner, and it should be most likely a non-trading entity, and the directors should be same, and it does not have any other role to play other than just to hold the property. It doesn't need a tax file number, no ABN, no bank account. It's not collecting rent. It's not lodging tax return. And the trust itself is not like a discretionary trust. Uh, the property custodian trust has only one beneficiary, and that beneficiary is the trustee of the self-managed super fund. So, in all terms and purposes, the trustee of the self-managed super fund is the boss in the whole arrangement, whereas in a normal discretionary trust, it's the trustee of the trust which is in control of the transactions. But here, it is the super fund trustee who is in control of the whole transaction. Now, I've mentioned that the property custodian trust should have only one asset. So if you're buying a house and a garage, or buying an office and a garage separately, you need a separate property custodian trust for each property, each separate title, and then if, let's say, I looked at a situation. I'll give you an example. I looked at a situation where there was an office and there was an option to buy a car park, and every car park had a separate title, and the super fund decided to buy 10 car parks. So we ended up with 11 property custodian trustees, one for the office and one for each car park. But the trustee of the property custodian trust, the company or the individuals, whoever end up to be the trustee of the property custodian trust, can be the same and one only person. Now, if you don't do that, then obviously what will happen is that the property custodian trust, if you don't, if the property custodian trust is not drafted properly, then what will happen is that that property custodian trust would be considered as a separate trust. And when you sell the property to the super fund, then the super fund might end up paying stamp duty, and this trust might pay CGT again. So we have to make sure that when the related party is borrowing, first there is a property custodian trust in place, and that property custodian trust has the right definitions for all the entities and ensures that the absolute benefit in that trust belongs to the trustee of the self-managed super fund. Now, I mentioned that the property can also be sold by a member. That means the super fund can acquire from a related party, but it should be a business use property. It can be listed shares as well. And whoever is selling, there could be a capital gain tax issue for them. So if the members sell their property to the super fund because they are transferring the property to the super fund, they may be subject to capital gain tax. In New South Wales, when you transfer a property from members to the super fund, then under the Stamp Duties Act, Section 62A, and the duty to be paid is only $50, so the whole property can move. But as long as the asset is held by the super fund for the benefit of those members. So let's say there is one member which owns a property and there are four members in the super fund. So when that property goes in to claim that exemption on stamp duty, that property should go in for the benefit of the same member who owned it prior to the super fund owning it. Now, a PCT, a property custodian trust, can also acquire that interest, and the fee there is $500 in Section 62A(3) of the New South Wales Stamp Duties Act. Now, other states have similar exemptions, and urge you to, if you are from another state, I urge you to check that. Now, if a related party is selling to the super fund, then stamp duty will apply. So let's say if a company owns uh, a business real property, if the company owns the factory, and if the super fund wants to acquire that factory, then super fund will end up paying the stamp duty. And let's say a discretionary trust owns that property, and if the super fund acquires that property, then the super fund will end up paying stamp duty. So the exemption in the Stamp Duties Act is only to the member. When the member sells it to the super fund, no stamp duty is payable. Another thing is that if the member has a loan on that property, that has to be removed before the super fund can acquire it, and that will happen in the settlement if the super fund is paying for that property. So a part of that payment has to be to the existing lender, and that mortgage has to be removed by the existing lender, and the new mortgage by the new lender has to be installed on that property. Now, there are a lot of commentary on you cannot sell residential property to the super fund. That's not true. It is possible, and that possibility is because, let's say, there is an investor. He owns lots of properties, and it's his business to own residential properties. So I urge you to look at SMSFR 2009/1, example 13, 14, and 15, where in those examples, in that ruling, it is mentioned that one member had 20 residential properties, and they were and he wanted to transfer some of those residential properties into the super fund. And what was noted in those examples is that it's the number of properties which you own. So it should be like a business of the member of owning residential properties, and also whether the ownership was like business like manner, that is, was an agent used, or who was doing the repairs, who was looking after collection of rent and things like that. So if you have a large number of properties, residential properties, some of it can be sold to the super fund. Now, if you look at this ruling, they have a very large number, like 20. So if your client has 7 or 8, I suggest that you apply for a private ruling before you decide to transfer the residential property into the super fund. Now, there are lots of residential properties which are used as business use properties, like childcare centers or doctors' surgeries and things like that. So, predominantly, they are residential properties, but They are being used as business use properties, so you have to be careful on what the zoning has been permitted by the local council. So they look at the use of the property, whether the property is being used as business or not, rather than what the character of that property is. Now, when there is an external lender, you can go to NAB, Westpac, St. George, ANZ. Um, you have to be very careful because now they have tightened lending to self-managed super funds, and they are only lending to existing customers just to satisfy their need instead of lending to the general public. You'll notice that the interest rates are a bit higher because banks are opportunists. They want to make more money, so they will lend to their existing customers, but at a higher rate. Personal guarantees can be provided to banks. So I find this really very funny because the tax office is saying that it's okay. Uh, that means that if the super fund does not pay, the super fund, the lender can recover from that property. So it's a non-recourse. So let's say the bank lends $1 million and that property sells for 700,000, and there are other assets in the super fund. But the bank cannot go after the other assets, but the banks have lent money on personal guarantees of the member. So they can go to the member directly and recover the balance 300,000. So it's not really a non-recourse loan. There is recourse because personal guarantees will make sure that the lender gets paid out at any one given time. That is in case of default. I've never seen personally any personal guarantees being evoked by banks. So it's probably one thing which is never used by banks. Now, we should make sure that the property custodian trust never borrows. Uh, the borrower should always be the trustee of the super fund. And I've discussed that 71(8), after the borrowing is repaid, then the property can continue to be held by the trustee of the property custodian trust. Now, I'm quite aware of the time. I have 10 minutes left. I'll try and cover as much as possible. And I want to reach the auditors area because I'm looking at quite a few default cases where the principal and interest has not been paid, and I want to discuss that a bit more. Now, who should be the related party? And if it's a company, then we have to look at the Income Tax Act, Division 7A, and we have to ignore the interest rate which is in the PCG 2016/5. We should be looking at the Division 7A loans, and because the LVR is only 70%, then the term of the loan cannot be more than 7 years or more, and then the principal has to be repaid. And I've seen many super funds where the related party is a company, and the related company has lent money to the super fund, and Division 7A has been ignored, and loans of 15 years have been taken, whereas they are okay as far as PCG 2016/5 is concerned, but it's not okay because of Division 7A requirements. So just watch out there. So you have to make sure that the loan cannot be more than 7 years. The other place where I find the documentation is deficient is in the loan documents. There's no proper loan document. It's just money being transferred, and there's no terms of the loan and what will happen if the borrower, that is the super fund, fails to pay regularly. That means that the mortgagee will take that action and give certain days notices, and all those terms which a bank would normally have in their lending documents are absent in those kind of situations. Now, Who can be a related party? And this could be seen, we're looking at Part 8 associates in the SIS Act. We're looking at Section 70B, a relative of the primary entity, and the primary entity is the member of the super fund. So each member of the super fund, each relative of the super fund, a partner of the super fund a partner of a member of the super fund, and the spouse of the partner of the member of the super fund, um, they all get included, and the trustee of a trust where, that member is a trustee of a trust, so they all become related party. And a company where the member has controlling interest in that company becomes a related party of the super fund. I also urge you to look at Section 70E of the SIS Act, because whatever terms are used in 70B and 70C and D, are explained a bit more in detail in Section 70E, as far as how the controlling interest is established. It's not only the number of units or number of shares you own. It's also could be directorship in that company, or how you could actually control that company, which becomes a related party. Now, the way the internal loan will work is basically a member will bring money from somewhere, and it's quite possible that the member will have some equity in their own home or equity in investment properties. So the bank will actually maintain a mortgage over those properties and not touch the property of the super fund. And then that cash is injected by that member as a loan into the super fund, and then installs the mortgage on the property which the super fund acquires. Now, the repayment of loan, and this is a new thing which came in the TLA 81 number 2, where the transfer balance credit gets credited for a member. Now, I'll just talk about it slowly. We know that the transfer balance of a member cannot be more than 1.6 million in retirement phase. So it's quite possible that there is one member and his transfer balance credit is already reached 1.6 million and he is in retirement phase. And now we are trying to repay this loan. And this loan, remember, can be from a company and only a 7-year loan. So it's quite possible that the loan is being repaid from the accumulation interest of the member. And as soon as you pay the accumulation from the accumulation account, the rent is coming in, and what it is doing is it's increasing the value of the superannuation interest of the member who is in retirement phase. And once that happens, that means the member's interest is actually increasing in retirement phase. So, to safeguard that or to protect that transfer balance cap amount of 1.6 million, this legislation was put in, and it is Section 294-25 of the Income Tax Act. Now, because of the backdating of legislation, this TLA 81 talks about only new borrowings, that is, the new contracts, which would be entered from 1st of July. Now, where this money comes from, it is up to the trustee who will need to identify the source of the payments. So I don't know how this can be achieved, and this is the first year it is happening, so there's no evidence of actually happening. I have not personally seen it, because it will be after the 2017 and 18 accounts. We will have to see how the accumulation account actually repaid the loan amount. Now, as far as the property is concerned, you can buy shares, commercial, residential, car park, storage facilities, artworks, antiques, stamps, anything can be acquired. So it could be any asset which the super fund can acquire. Um, you have to make sure that it's if it's from a related party, the 5% rule is applicable because you're acquiring from a related party. So the assets which you acquire or from a related party cannot be more than 5%. Otherwise, it will become an in-house asset of the property. So in-house asset of the super fund. So you should be very, very careful. Now, the non-recourse loan arrangement, you have to make sure that the property custodian trust is just holding the property, and the benefit of that property should not be with the property custodian trust. The benefit of that property, and how would you establish that? So it's quite a challenging task, but it'll be up to the auditors to read the property custodian trust deed to find that it is clearly that the beneficiary of all the assets of the property custodian trust are being held by the trustee of the super fund. So this could be something which auditors have never probably done before, that is to read a property custodian trustee. And some of the auditors would be thinking, I might as well get a declaration from the members that the section 67 A and B have been completely and correctly complied by, so that they don't have to read the property custodian trustee and make a comment on it. Now, another thing is that it should be an existing asset. It should not be to improve an asset. And improvement means that you cannot like buy the land with cash and borrow to put a house on it, because then the character of that asset will change. You can look at SMSF 2009/12, and it talks about whether you can put a swimming pool. Yes, you can. Can you put a granny flat? Yes, you can. So you can do certain things so that it doesn't change the character of the property, because it will still remain as a residential property. But you cannot, let's say, buy land and split it into two, because then cannot put a duplex on it, because then it becomes a different property what it was. Now, as far as interest is concerned, you cannot use a 13-month rule, so you cannot pay interest in advance. Auditors, please be careful, because sometimes you will see that in June or sometime closer to the year, the super fund is trying to claim a higher deduction and trying to pay interest upfront. That is not allowed because of Section 82K ZMD, because the super fund is not carrying an enterprise, it's not carrying a business, and it's not allowed to pay interest more than $1,000 in advance and claim a tax deduction. Another thing is that you'll see that some members are in pension phase, and you have to see what can be claimed as a deduction. So a percentage can be claimed if they are accumulating members in the fund. But if all the members are in pension phase, it's 100% segregated pension fund, then obviously no deduction can be claimed by that fund. Now, there could be problems with all of these issues, so I'm just going to jump into the area which is going to is for the auditors. This is a very interesting example, and this was a very success story. What happened is that this was four couples, a syndicate, which owned a Red Rooster, a property which was selling, which was being rented by Red Rooster. And this four couples syndicate, they were all in their 60s. So what we were able to do, because the members themselves held a 1/8 interest in the property. So what we did was we created a forced self-managed super fund, and one couple became member of each one of the fund, and we transferred the property into the super fund. And what the four couples wanted to do was not pay tax on the rental income from a certain date. So on the date of transfer, the four couples paid capital gain tax, and once the property moved into the super fund, then those members were put on pension, and then each one of the super fund started receiving rental income. And because the members were in 100% segregated self-managed super fund situation, then they did not pay any tax on income, whereas earlier on each one of those eight people were paying tax on income. So this is one thing, you have to think about opportunities outside the box for your clients and see, whether creation of self-managed super fund will help them to reduce their tax. Now, at this point of time, if you are just an accountant without an AFSL license, there are limited things on what you can talk to your clients. You can just give them factual information about what the law says. A strategy, something like this, would need a statement of advice from a qualified financial planner. Right. Now, I'm just going to talk about issues with audit. There's another thing which I need to talk about. I don't know why a related party should actually lend to the super fund, because what you can do is, with the related party, you can buy units in a unit trust. The super fund can put 30%, the related party can put in 70%, and the rent can come in into the unit trust, and the unit trust can then distribute the income over time to the various parties, and in this situation, what can happen is, if it's a fixed unit trust, even if it is a residential property, super fund can actually acquire from a related party because of Section 71H. This unit trust is not an in-house asset, and the conditions are that there should be no borrowing on this property, there should be no loan on this property, and the unit trust should not have borrowed any money. So if the related party has money, so let's say members have money and the super fund have money, together they can subscribe to units in a fixed unit trust, and that fixed unit trust will end up buying the asset. And over time, the super fund, when the super fund has more money, they can acquire the units from the related party. So they're not acquiring the residential property, they're acquiring the units in a unit trust. So some of the auditing rules, which what the auditors need to look at. The first thing is, does the trust deed allow borrowing? So you should think of updating the trust deeds and things like that. And fund which is claiming the exempt pension income, whether deductibility of interest, whether they are claiming any interest or not, investment strategy, has that been amended or not, and who is borrowing? Is the super fund borrowing, or is the property custodian trust borrowing? You have to make sure that the loan documents are first of all present, and they name the trustee of the super fund, and whether there is a mortgage over the property or not. We've discussed that, the PCG requirements, and whether principal and interest is being paid or not. And you will see in many, many cases that principal and interest is not being paid, the safe harbor rules are not being followed, and then that would require you to actually lodge a contravention. The next thing is, you should also look at the GS 009, the valuation of the property. This could be very important because on 30th of June 2017, if they are members, some members are in pension and they were on pension on the 9th of November 2016, uh, whether they want to reset the cost base of those properties or not, and whether the calculation of the transfer balance cap is correct or not. So if there are properties there, the valuation should be right. not only for the minimum pension withdrawal purposes, but also for the transfer balance cap purposes. And the actuarial report, whether correct income has been included in the income tax return or not in the current year. Because you see, there could be different terms, different interest being paid up to 31st of January, and then from 1st of February to 30th June, the fund may have complied to the interest payment, and then there could be a different amount being claimed in certain periods. And if certain members went into pension during the year, that could create further complexities as well. We know that minimum 10% should have been withdrawn if there was a transition to retirement pension, and we know that transition to retirement pensions cannot claim um, any deductions, cannot claim any exemptions from tax. So it's possible that next year, that is 2017 and 18, that that a member is on transition to retirement pension. That means that there is no tax exemptions. In those cases, interest may be claimable because there's no exemptions on transition to retirement pensions. Now, repayment, that's really a big issue. Um, and this is where you'll be lodging a lot of contravention reports where the repayments are not being made according to the 15-year plan, and or if the lender is a company, not according to the Division 7A 7-year plan, and this is where you will be lodging a lot of contraventions. The second thing is exchange property with the trustee of the PCT. Many times I've noticed that on the contract they have named the trustee of the super fund, so that could be a little bit of an issue. So what's really critical is good documentation, and the problem is that you can't go back in time and alter documents. That could be a breach. Now, a related party is cheaper, but make sure in going forward that is not from a company, and it is either from members directly or from a trust or some other entity, but not from a company. Now, renting of business real property to related parties to pay off the loan, make sure that the rent which is being received by the super fund is at market rate, because there could be some naughtiness there. Many trading entities would like to pay more than the market rent. So perhaps a letter from a real estate agent, or if it is more than 7 or 8 or more than 10%, perhaps a letter from a qualified valuer of what the market rent should be because of Section 109. By the way, Section 109 is one of those sections which you have to report on, and it is included in your audit report. Now, if the super fund sells the property to a member, you will see, because of the CGT rules, a lot of properties were being actually, because they wanted to reduce the member balance, they wanted to take the cash out. A lot of super funds have actually removed those properties from the super fund. You have to check on the CGT calculations, and especially if some of the members were in pension phase. You have to look at the investment strategy, the arm's length situation, as far as the lending and the rental income, if it is, rented out to a related party. Uh, Again, you have to check the title deed of each property, whether it is a single acquirable asset or whether they are multiple assets. Usually, when there is a bank, they look into all of that. But because there is no bank, I think the onus is on you as an auditor to check whether the asset being financed is a single acquirable asset or not. Refinancing is permitted as long as there's no additional amount is borrowed as part of the refinance. So it could be a very good strategy. So let's say the super fund wants to buy a $1 million property and 700,000 is being borrowed. And over 5 years, you have reduced the loan from 700 to 500, and the property has gone up say from 1 million to 1.2 million. So the related party can lend again to the super fund. So refinancing is okay, but they can refinance only up to the 70% LVR of that property. So, if you think LVR is a challenge, it's difficult to maintain, but over 4 or 5 years, because you're repaying the loan, it's possible to get the money back into the fund by a refinance deal. And again, that would mean that it's a new, fresh LRBA. Another thing is you can repair but not improve the property. Have a look at ruling 2012/1, where I mentioned that a granny flat is okay, a swimming pool is okay, and things like that. And of course, once the loan is repaid in full before 31st of January, say for example, the asset can remain with the trustee of the property custodian trust. So, folks, that's the end of the presentation. I will look at the questions, and then I will also upload the slides in the handout area. Just to let you know that we sell internal loan documents. So if a super fund trustee is borrowing from a related party, we can provide you solicitor drafted um, loan documents, solicitor drafted property custodian trust deeds, solicitor drafted constitutions. We can give you an investment strategy as well, which is updated to include borrowing. So if you go online and have a look at the borrowing page of the website, we have provided quite a few tools for you. There's an information sheet as well, and you will have a copy of this handout as well. So what I'm doing is I'm stopping my presentation, and I'm going to look at the questions. And after I've answered the questions, I'm going to upload my slides for those who want to have a look at it in their own time.